Why don't you weigh in here, Art, and tell us what the real deal is?
That's interesting. I guess that's what makes markets, the perception of what an inverted yield curve means, and especially in this new environment where we've had interest rates held low for a decade by aggressive monetary policy. I will tell you this, that I think the inverted yield curve certainly has a very high batting average for being a predictor of a recession. Unfortunately, it's not just a predictor, it's causal. And the reason for that is financial institutions, banks, stop the lending process if they can't borrow short and lend long and make a profit. It slows down economic activity. But I will tell you this, because a yield curve is flattening, it doesn't need to invert. And there's three things I think that can happen, and any one of them could help. I think the composition of the balance sheet, the Fed's got a $4 trillion balance sheet. If in fact the roll-off starts to focus more on the front end of the curve than the back end of the curve, then you could see some spreading there. If the Treasury new issuance focused less on the front end and more on the back end of the curve, you could certainly see some spreading out there. And the third thing is, we may not be the only central bank that's raising rates at some point in time, either by the end of this year or the start of next year. And that's what's really kept the long end of the curve down. We're the only central bank that's taking away accommodation, so our 2 years matching our monetary policy, whereas our 10-year is really anchored to what's going on in global interest rates. If you saw any uptick, the ECB starts to take some accommodation away in the fourth quarter and the first quarter, you might see a lift there, and that could broaden out. So just because we're flattening doesn't mean we need to invert, but inversion would be bad, and the Fed's paying very close attention to that.
So it seems like you kind of agree with the San Francisco Fed yesterday. So this is what they said in one of their papers. They said there's no clear evidence in this data that this time is different, or that forecasters should ignore part of the current yield curve flattening because of the presumed macro financial effects of QE. They basically tried to strip that out and just look at expectations. And they said, look, it doesn't matter why the long end is down. It just matters if you invert. And that either way, you're looking at a recession risk. What part of the curve do you look at? We talked 2s, 10s. Mike McKee brought this up. We have a chart in our terminal that says the Fed, in the San Francisco Fed paper, says it's 3 months versus 10-year, and we're well off any kind of inversion here.
Right. And I think the most popular to look at is the 2-10s, but the 3-month 10s is if that's what the San Francisco Fed's looking at, that's fine as well. As long as they're paying attention to this and realize that it's a dangerous situation. And the fourth thing that we didn't talk about, the Fed could certainly slow down on their tightening process. They can slow down. They don't have to go in December. They can. They know they want to raise rates 4 more times and get to that sort of neutral rate, but it doesn't have to necessarily happen at the rate the dot plots are telling us right now.
Or does that mean that the bond market can dictate what the Fed does? If they keep pressuring the flattener, Mr. Bostic's going to say, you know what, I'm not going to hike into that inversion.
I absolutely think the Fed is watching the flattening of the yield curve and will change their actions if it remains where we are, 20 basis points or anywhere, below 50 basis points. I certainly think it's going to affect their behavior, because I think they know that the end result of an inverted yield curve is not something good 6 to 18 months down the road.